The last couple of sessions, we've introduced the notion of using option pricing in valuation. In fact, last session we talked about the option to delay. In this session, I hope to introduce two more options. The first is the option to expand, where essentially a company has made an investment that right now doesn't look very good, but has the potential to give them a chance to enter a much larger market or a much larger business. That is the option to expand. The second is the option to abandon. It's always nice to be able to walk away from your mistakes, and an option to abandon allows you to quantify that advantage. Companies that have options to expand and options to abandon are going to be undervalued using conventional valuation approaches, and bringing in these options will give you a more realistic estimate of what those businesses are worth. I hope to expand on that concept in this session. Companies sometimes take investments knowing these investments are bad investments. Sounds like a crazy thing to do, but they might have a good basis for it. In this session, I want to talk about two potential options that show up in investments that sometimes allow companies to take bad investments without really destroying value. The options I'm going to talk about are the options to expand and the options to abandon. So let's start with the option to expand / take other investments. Here's how the rationale goes. I come to you with an investment that I know is going to lose you money, but I try to convince you that it's still okay. And here's my rationale. If you take this investment, it'll give you a chance to enter new markets, much larger markets potentially, and produce new products. So even though this investment is not a good investment, it could lead to some great investments, blockbuster investments. Now, usually when you see this argument made, you'll see it framed as a strategic investment, an investment that you're making knowing it's going to lose money, but because you think you could get other things down the road. Not an unreasonable argument, but I'd like to put some flesh on this argument. To understand the option to expand, I'm going to go back again to a device we've used increasingly through these option pricing sessions, which is a payoff diagram. And here's how the option to expand works. You have an initial investment, which is not an option. It's a negative net present value investment. It's a bad investment. It's the price you're paying to get an option, and the option is the option to expand. It's in the future. And here are the characteristics of that option to expand. You know what the cost of expansion is going to be. That becomes the equivalent of your strike price. Based on what you know about that potential huge market out there, you have a value of cash flows from expanding, which right now is probably well below the cost of expanding. That's why you haven't done it right away. But who knows, the market could evolve and become much larger and more viable in the future. So if the value of the cash flows from expanding exceed the cost of expanding, you're going to expand and walk away with the difference. If that never happens, you know what you lose? That initial investment you made had a negative net present value. You're going to write off that value. I'll give you a very simple example to bring this home. Let's assume you're Marriott. You decide to open 10 hotels in China, and these are your first 10 hotels. You estimate the expected cash flows, and you conclude that these 10 hotels can expect to lose you money. So why would I do this? Well, if those hotels do well, presumably you have expansion plans where you could expand to 100 more hotels in China. It's a big market. That's the option to expand that we're valuing here, is the option to open the 100 more hotels. And therein lies some of the weaknesses that we'll come back and address later in this session. But I'll give you another very simple example with numbers to kind of illustrate valuing the option to expand. I don't know whether any of you visited Brazil, but I have. And when I first went to Brazil, I was offered this soft drink called Guarana. My pronunciation is probably not right. I'm not rolling the R's the way most Brazilians do. But it's produced by a company called Ambev. Ambev is the largest guarana manufacturer in the world. In fact, it probably owns 95% of the market share of the product. So let's say you're an up-and-coming product manager at Ambev, and I'm your CFO. You come to me with an idea. You said, let's take guarana to the United States. Huge beverage market, right? I'm the CFO, so it's my job to be skeptical. So I ask you, how much will that cost us? And you tell me. You say that you're planning to do it in 2 phases. In the first phase, you plan to take it to the big urban markets in the United States. And it'll cost you $500 million to go into the big urban markets. Then I ask you, how much do you think we'll make in these markets? And you're pretty honest about it. You say, well, based on what we know about these markets, we can expect to make about $400 million. So you've already conceded to me that the initial investment, that first test market, is going to have a net present value of minus 100 million. I get ready to shut the door on you. You say, wait, I have more. And here's what you have. You say, if that initial investment works, we could go into the rest of the United States. So how much will that cost us? Cost us about $1 billion. And based on what we know now, how much do you think we can make as cash flows in the rest of the US? And you tell me it's 750 million. This is going from bad to worse, right? You have an initial investment with a net present value of minus 100 million. It'll give you rights to a second investment with a net present value of minus 250 million. But here's the catch. That second investment, you can wait to see what happens to the first investment you make. And in your advantage, you know very little about the market. This is one of those few cases where ignorance works in your favor. Because you know so little about the market, who knows? That 750 million that you've estimated as the expected value of the overall market could become 2 billion. That's where the value of the option comes from. So let's see if we can put some numbers on valuing this option. Let's start off with the value of the underlying asset. Based on what you know right now, you've told me it's 750 million. That becomes the equivalent of the value of the underlying asset, or the S in the model. For the strike price, I'm going to use the cost of expansion, $1 billion. This is an out-of-the-money option. Let's assume, and this is a fairly arbitrary choice, that you have to fish or cut bait within 5 years. You've got to make your decision within 5 years. And most companies don't go into markets without an end game. So in this case, let's assume that's 5 years. And to estimate how uncertain you're about the market, I'm going to cheat. I'm going to cheat because rather than estimate the variance in the value based on a Monte Carlo simulation, I'm essentially going to estimate the variance looking at publicly traded beverage companies in the US, and that's 34.25%. That is the standard deviation you're going to see in the valuation of this option. I plug the numbers in an option pricing model, and magic happens. The value of this option is 234 million. I say, what does that tell me? Remember that initial investment had a net present value of minus 100 million? It's giving you the rights to an option with a value of 234 million. If you consolidate those two numbers, you come up with a net number of 134. What does that mean? In this case, if you buy into the value that I have for the option, you're actually going to make that initial investment knowing you're going to lose money because the option value is so dramatic. Again, you can see why people like to use this argument if they really want to take an investment. Especially when you're looking at markets that are very large, geographically like China, or a particular product area like smartphones. Companies will often take bad investments and justify it by saying, hey, there's the option to expand down the road, which makes this okay. So I'm going to add some rigor to this process. When you see this argument made that there's an option to expand or a strategic investment, here are the questions you need to ask. First, do I need to make that first investment to get to the second? I've tied the two investments together in my example, but do they have to be? Could somebody else do the market testing for me? That's great, right? If you could get a competitor to do the market testing and you jump in after they do it. Second, how much exclusivity will you have, assuming that first investment pays off? In the case of InBev, the answer might be a great deal. We've patented Guarana. But in the case of Marriott, the example I gave you with the 10 hotels, assuming they do well, what was the plan? They were going to open 100 more hotels? Well, how are they going to stop Hilton or Holiday Inn from doing exactly the same thing? Where's the exclusivity? And third, assuming you expand, what are your competitive advantages? How are you going to keep the competition out? So you can see that to use the value of the option to expand, you have to have lots of assumptions come together. And when they do, I think you have justification for arguing that you might take some negative net present value or bad investments. So that's the option to expand. Let's talk about the final real option example I want to use, and that's the option to abandon. When you make a mistake, it's always nice to be able to walk away from those mistakes, right? And in the context of a project, especially if it's a long-term project, especially by year 2 or year 3, if you get early indications that the project is not working, it'll be nice if you're able to shut the project down and walk away. That is the option to abandon. So here's how it's structured. It's one of the few put options in real options. If the value of the underlying asset drops below that abandonment price, you're going to abandon the asset and collect the abandonment price. If the value of the asset stays above the abandonment price, you're never going to abandon the project. In which case, what do you pay? You pay whatever price you paid to get that abandonment option in the first place. Again, let me use a simple example to bring this home. Let's assume you work for Lear Aircraft. It's a small aircraft company that manufactures primarily corporate jets. Let's assume that you're interested in creating a small commercial airliner. You don't have the expertise to do it, so you come to me, and I'm Airbus. And you want to enter into a joint venture. You're going to put in $500 million, I will put in $500 million, and we'll produce commercial aircraft. As Airbus, I'm skeptical. I don't know whether I want to do this. I work through the numbers, and I get even more skeptical. The value of the expected cash flows in the investment is $480 million, and my initial investment is $500 million. The net present value is minus $20 million. It's not a good investment. So I turn it down. But you really, really want me as your joint venture partner. So you come back to me with an idea. You tell me that if I become part of this joint venture, I have the right, as Airbus, to walk away anytime I want over the next 5 years. It's a 30-year investment, but I get the right for the next 5 years. And if I do, I will get $400 million. Less than the $500 million that I invested, but still it provides a downside protection to me. I cannot lose more than $100 million of my $500 million investment. You've essentially given me the option to abandon this investment. Would I use it right now? No, because the present value of the cash flows I've estimated right now is $480 million. My option to abandon is at $400 million. This is an out-of-the-money put option. But there's uncertainty about the future. If bad things happen over the next 5 years, that $480 million could drop to $300 or $250 or $200 million, and then I'm going to exercise my option and collect my $400 million. If I value this option, as a put option, the value that I get is about $73 million. You're saying, how am I going to use this? Remember the original net present value was minus $20 million? That was without the option to abandon. With the option to abandon, having a value of $73 million, my net value is now plus $53 million. Doesn't guarantee that I as Airbus will join you as a joint venture partner, but you've increased the odds. So if you ask me to summarize what you should take away from the option to abandon, here's what I'd take away. When you look at projects and you compute expected cash flows, think about how much flexibility this company has built into its operating processes. Flexibility in what sense? By entering into short-term contracts rather than long-term contracts, by having flexible wage contracts rather than fixed wage contracts. Companies that build in escape hatches, that have more flexibility to deal with what's happening out there, should be more valuable than otherwise similar companies without that flexibility. The option to abandon is a very simple way to value the flexibility that companies have built into their business models. And flexibility is a good thing to have.